I think we have a quorum. Ravi, please, I give you the floor.
Okay, warm welcome to everyone. It's my great pleasure to welcome you to the NGFS outreach on the third vintage of the NGFS Scenarios. The NGFS Scenarios, as you know, were published earlier this month on 6 September. And as chair of the Network of Central Banks and Supervisors for Greening the Financial System, the NGFS, I'm very pleased to invite all of you to the discussion that we're going to have on these scenarios. The NGFS, as you know, is a coalition of the willing, comprises central banks and supervisors, committed to sharing best practices, contributing to the development of climate and environmental related risk management in the financial sector, and also to mobilize mainstream finance to support the transition towards a sustainable economy. As of today, membership in the NGFS stands at 116 central banks and supervisors and 19 observers. Before we get into the presentation, let me first say a big thank you to the Bank of England, and in particular Sarah Breeden, and also to the European Central Bank and Cornelia Holthausen, who are both here. So thank you, Sarah, and thank you, Cornelia, for your leadership in developing one of NGFS's flagship products, the Scenarios. I also want to say a special thanks to the NGFS Secretariat for the critical role they played in bringing the work on the Scenarios to fruition. And also convey my thanks to several of you here who, as experts, were advising us in this work. They were deeply involved in this work over the last year. I know some of you are here today, so thanks for coming. Just by way of introduction to the issues we are dealing with now, the NGFS climate scenarios seek to provide a framework basically to assess and manage climate-related risks. They explore both the physical impacts of climate change and the transition impacts of climate change mitigation. And they do this over a long horizon under varying assumptions. Today, we build on the good work of the two previous iterations of the NGFS scenarios. So this third vintage of the NGFS scenarios will include projections of the potential losses from extreme weather events like floods. And this will complement the specific impacts of chronic climate change on the macroeconomy that we did in the previous iterations. They will also shed light on the potential disruptive impact of the current sharp rise in global energy prices and the importance, of course, of securing an orderly energy transition to net zero. In fact, the current energy crisis in Europe and the global spike in energy prices quite vividly demonstrate that a disorderly transition scenario is a more immediate scenario. In fact, we're facing a rehearsal of that scenario right now. It's no longer hypothetical. So we've therefore published a note as a companion to the scenarios work. And this note confronts the growing odds of a late and disorderly transition. And this note was prepared by an ad hoc group led by Luis Pereira from the BIS shortly after the publication of the third vintage scenarios. And so I want to thank Luis and the team as well for putting together this very excellent note that allows us to clearly highlight the unique opportunity that we have today for a decisive transition to net zero. The basic message is this: the risk of a disorderly transition has clearly increased due to the energy crisis we are facing now. The NGFS scenarios also show that a no transition scenario would have extremely negative economic and social costs in the long run, driven by more frequent and adverse natural disasters alongside chronic and irreversible changes in the climate. We are already seeing some of these disasters in the form of droughts in Europe, in China, in America, and the devastating floods in Pakistan. So we are seeing actually both real climate change events and also transition events, such as the spike in energy prices. All of this is showing us very clearly that an accelerated green transition is the only opportunity that we have to meet the Paris target while minimizing the costs of that transition compared to taking other alternative options. Of course, in developing the scenarios, we were very conscious that the use of the NGFS scenarios extends beyond our community of central bankers and prudential supervisors. These scenarios are an important public good for all stakeholders, both public and private sectors. So the NGFS is very eager to hear the industry's feedback and to better understand the needs of financial institutions and the broader private sector. And we will use this feedback to continually reiterate the NGFS scenarios and improve them and make them suitable for a wider range of applications and users. So to the industry participants in today's discussion, I strongly encourage you to provide your feedback. You can raise them in the Q&A portion at towards the end of this session, or write to the NGFS Secretariat team directly. So with that, I'll now give the floor to Sarah Breeden, who will say a few words, and then followed by Cornelia Holthausen, who will present to you the enhancements made in this third vintage of the scenarios. And the NGFS consortium of modelers will then dive deeper into the methodological aspects of the NGFS scenarios. So with that, over to you, Sarah.
Ravi, thank you for those words. I'm afraid that Sarah's been called away for something quite urgent, literally at the last minute. So she's asked me to step in. My name is Chris Faint and I'm head of the Climate Hub division at the Bank of England, which is hopefully going to join us. So if I could say a few words on behalf of Sarah and the bank, just by way of introduction. The first thing is to say thank you everybody for being here. I hope very much that you find the new tranche of scenarios as valuable as we have. And this is, of course, the latest position following what has been an exceptionally busy year. So for context, let me just say a few words on how we got here and why these scenarios are so important. And they are really important because as central banks, supervisors, financial firms, and real economy actors, we have a responsibility to prepare as far as possible for a variety of future states of the world. And scenario analysis really allows us to do just that, shining a light on how the impacts and exposures arising from climate change may evolve under a range of potential pathways. Now, when the NGFS first embarked on this journey in phase one, which was just 3 years ago, we set out to develop a set of scenarios which explored the physical and transition-related impacts of climate change within a common, coherent framework that aimed to support our understanding of the totality of the risks posed by climate change. In releasing the first iteration of those scenarios, it was our ambition and objective to lower those obstacles facing central banks and supervisors who wanted to begin sizing their financial risks from climate change in their own jurisdictions, because the hurdle was really high to doing it. And I think it's fair to say that the NGFS scenarios, as a set of comprehensive, publicly available climate pathways, were totally unique at the time of their release, and I think it's fair to say they're totally unique still. Our progress in phase two was substantial with the introduction of the Niger macroeconomic model to the package. The NGFS scenarios were elevated to include nearly 1,000 economic, financial, transition and physical variables across 6 different scenarios. And indeed, the scenarios also contained information at the country level for the first time, which is obviously incredibly important. These were significant improvements, and we maintained our commitment to be transparent by hosting all of the scenarios within a dedicated open access portal. The NGFS Scenarios in Action report was then released in October 2021. And what it did, it was highlighted the extent to which the phase 2 scenarios were key for an increasing number of NGFS members who are undertaking scenario analysis. The report found that 31 of those members are conducting their own exercises, with a large proportion of those relying on the NGFS scenarios. And these findings really represent an enormous amount of progress since 2020, when virtually nobody was doing scenarios, and underscored the importance of the NGFS scenarios as a catalyst for making that happen. So as Ravi just touched on, what is new within this latest phase of the NGFS package? Well, in addition to being updated with the latest model versions, population and GDP data. Phase 3 of the scenarios includes projections of the potential losses from extreme but ever more common weather events, such as floods and tropical cyclones, for the first time. The financial impacts from these hazards have been included alongside the impacts from chronic climate changes, providing a more detailed picture of the way that physical climate risks could impact the macroeconomy over time. And we think this represents a really huge step forward, especially given the limited coverage that acute physical risks have had in scenario pathways to date. We've also made available the results of our exploratory project with the G-cubed general equilibrium model, recognizing the value of these outputs for comparing the approach taken by different modeling frameworks. Now, reflecting on the work of the previous 2 years, it is clear that the NGFS has made enormous strides in advancing understanding of the risks arising from climate change. This is, of course, a collective effort, and I would like to say a huge thank you to all of those involved with the NGFS workstream on scenarios, as well as our colleagues in the modelling consortium. Whilst our work and journey on scenario development continue, our efforts have demonstrated just how far it is possible to go in a very short period of time. Thank you.
Thank you very much. So I think I can take over from here, and someone is kindly sharing the slides. Thank you very much. So I'm very happy to present the newest vintage of the NGFS scenarios. So together with my colleague Livio Straka and the team at the ECB, we have taken over the chairmanship of this important work stream of the NGFS from the Bank of England, and Chris has just, Chris and Sarah and their team, we thank them very much for handing over the work in a very good shape and at a very advanced stage. So thanks really very much for that. We could go to the next slide, please. So I don't have to justify very long in this audience why we think the NGFS work is relevant. We have seen that over the past years, the trend has continued to have greenhouse gas emissions to be on the rise. And you can also see here on the right-hand side how this has impacted the change in global surface temperature, which is clearly visible, in particular this upward trending path, which is estimated to be the human influence on this. So all of this speaks for the importance of the scenarios, and that we understand better how we are impacting climate change and how climate change is impacting the economy. Next slide, please. So this slide gives in a nutshell the overview of the work that has been done in phase 3. You see here on the left-hand side in blue the main elements of the package that has been published. So the scenario pathways, technical documentation, where there's an update on the website, and there's also a review of scenario data. Now, in addition to that, on the right-hand side, you see the deliverables that have been contributed by various subgroups of the work stream. And this is on the macroeconomic policy assumption, a study on acute physical risks. Then there was a paper on macroeconomic modeling of physical risks. And finally, an occasional paper using the G-cube model that Chris has just talked about, that is looking at a more granular sectoral disaggregation. Next slide, please. So the key messages I would like to give you today, that we have seen some evidence that the NGFS scenarios today are really a common starting point for analyzing climate risk to the economy and to the financial system. They are starting to be more widely used. These scenarios use different models and explore a wide range of options. And one reason for that is because of the inherent uncertainty that is still there in the modeling of climate risk. Let me skip what has been, these scenarios have been brought up to date with, because Chris has already alluded to it. But really the key message, I think, that comes out from the scenarios, and I will go into more detail in a second, is that there are clear benefits of an immediate coordinated transition, because the costs of that clearly outweigh the costs that we would have if this was not the case. Next slide, please. So in the following, I will give you an overview over the scenarios, go a little bit into more detail on what's new, and then I will outline a couple of the main results of the NGFS scenarios, and then briefly touch upon what we are planning going forward. Next slide, please. So on the objectives, so clearly the NGFS scenarios explore the impacts of climate change and climate policy. And the idea is to have a common reference framework that can be used by everyone and also across the world. And what is done here is that so we look at 6 different scenarios, and broadly speaking, we are looking at what would be the impact of different climate policies globally and speaking on physical risks, so on temperature increases and the results thereof, and on transition risks, so on the economic costs from the transition policies. So the 6 scenarios can be classified as in the chart that you see here on the right, and in terms of the transition and physical risks that they generate. If you look at the lower right corner, you see, those policies, either no current policies, just to go on as we have done before, and also the NDCs, or the nationally determined contributions, which include some pledged targets, but not yet implemented fully into policies. So these 2 scenarios would lead to a high physical risk, but they are obviously relatively low or zero in terms of transition risks. And if you then move to the left-hand side, in the lower quadrant, you see, what would happen. So what would be the impact on both physical and transition risks if the net zero 2050 policies were followed, or maybe a little bit less ambitiously if the aim was to stay below 2 degrees. And then in the upper quadrant, you see what we call the disorderly scenarios, that meaning a delayed transition or a somewhat incomplete transition. So we will study the effects of these 6 scenarios. What is not done here is a judgment which of these scenarios is more or less likely. Next slide, please. And here we go a little bit more into detail what these scenarios entail, what are the assumptions behind it. So in the first 2 lines, you see the 2 orderly scenarios, so the net zero 2050, or the less ambitious one to stay below 2 degrees Celsius increase. In both cases, we assume that policy reactions are quickly, and then we have different assumptions on how fast the technology change is actually implemented, and also how widely these policies are adopted. So whether there's a lot of variation or whether there's very low variation, maybe because you can agree easier on a target. Then the next 2 lines refer to the disorderly scenarios, which may have a similar policy ambition, but a delayed or incomplete policy response, which would then mean that the technology change would start slow and then become a bit faster. So there we would have some negative effects because of that. And then in the last 2 lines, you see our assumptions related to the 2 hothouse world scenarios. So in particular, in the last line, the current policies, which means that there's basically no change in the technology or very slow change, but then also the carbon dioxide removal is really on the low side. Next slide, please. So for each scenario, it's modeled how CO2 emissions and carbon prices evolve, and there's actually a high negative correlation. So if you look at the current policies, for instance, that's the gray line. In terms of CO emissions, that's the only scenario where these are actually assumed to increase over the horizon we're looking at until 2050. But on the other side, on the right-hand side, you see that carbon price developments, they basically stay constant. On the other extreme, if you look at the net zero, so the most optimistic regime, that's a dark red line that's sloping downwards, meaning that CO2 emissions would go down relatively quickly. But then on the other hand, you see that the carbon prices would increase over time. And then let me point out the delayed one, that's this greenish line that first starts to move along current policies, but then has taking a sharper downward trend as policies are adjusted. And that, of course, also then very costly. So you see a relatively quick increase in carbon prices. So these are the different scenarios. And then the next slide, please. So which type of models are used? I think the answer is several, and there are several reasons for that. First of all, the very high model uncertainty and the difficulty to have one all-encompassing model that would capture all effects, but also because the different models are used for different purposes. So some look more at transmission risks, some look more at physical risks. And we try to combine them in a way that gives us the highest benefit in order to understand the different aspects of climate change on our economies. Let me go now to what's new in the NGFS scenarios. So please, next slide, and one more. Thank you very much. So the vintage 3 has seen several new elements, and Chris already outlined them very quickly. So the NGFS scenarios have been brought up to date with latest economic and climate data, policy commitments, and model versions. So now the phase 3 reflect the new country level commitments to reach net zero emissions made at the COP26 in November last year, but also the commitments made thereafter until including March 2022. The scenarios also include data to reflect the latest trends in renewable energy technologies, such as solar and wind and key mitigation technologies. And you see here on the chart the downward move in capital cost from the dotted lines to the solid lines from phase 2 to phase 3 scenarios. And also data for GDP and population in the scenarios have been updated since the latest snapshot from the IMF World Economic Outlook 21, and this includes any new effects related to COVID-19. The current data do not yet account for the war in Ukraine and its effects because the situation and the aftermath are still somewhat unclear and difficult to model. Besides, the models were already well advanced at this point in time. But as Ravi mentioned earlier, there's the companion paper by Luis and the colleagues at the BIS who try to shed a light on this. Next slide, please. So a second area where improvements have been made is on the modeling of physical risks, and here both on the side of chronic risks and also acute physical risks. So starting with the chronic risks, here now they better now account for model uncertainty. As you see here on the left-hand side, the GDP losses arising from an increase in global mean temperature are based on the damage function methodology that was set out in Kalkul and Vance, which can be used to extrapolate observed damages from year-to-year variations in chronic climate hazards due to climate change in the future. And the application of this damage function within the phase 3 scenarios, and this the yellow part or the lighter part in this chart, they now show a stronger impact and a wider range of uncertainty arising from increases in global mean temperatures. And also the 95th percentile of the impact distribution given by the damage function is now used instead of the median. And this was done to reflect better the uncertainty inherent in the modeling of the macro effects of chronic physical risks. So you see in the chart that the new damage function estimates they show they derive a set of impacts on GDP, and the GDP losses from chronic physical risks reaches up to 6% in 2050 and up to 18% by the end of the century in the current policy scenario. So quite a lot, I would say. Now, on the acute physical risks, so floods, for instance, they were included for the first time via the integration of stochastic shocks. And for the first time now, the scenarios provide an indicative illustration of the impacts of acute physical risks for different scenarios. And here, using historical shock data from the emergency events database, historic economic damages from weather-related natural disasters have been derived to model stochastic shocks for acute risks in the NIGEM model. And then multipliers were computed using selected climate impact explorer indicators to derive the future trends for acute risks and providing damage pathways for 3 of the NGFS scenarios. And these were then used as input to NIGEM for approximating future changes in damages to GDP. And then third, next slide, please. The scenarios have improved in terms of an increased sectoral breakdown. Now the reflection of the transport and transport and industry sectors has been improved across all scenarios within the two Remind and GCAM models, and within the message model, the industry sector has been updated with increased granularity. And then separately, again, the G-Cube model, there was a pilot project related to it, exploring the feasibility of that model for improving the sectoral breakdown of the scenarios. And it was not possible to integrate that model into the phase 3 package, and that's why the results and data are available for download, and you find them also on the website as an occasional paper. Next slide, please. So we go now to the main results of the scenarios. So one key variable studied are, of course, the effects on GDP. And here we see very clearly how different scenarios lead to different outcomes. So here in this chart, if you look at the left-hand side, so you see here GDP impact for 3 scenarios. On the left-hand side, they refer to the net zero, so the most ambitious scenario. And you see both transition risks materializing. This is the yellowish part, but also physical risk, that the blue and the gray shaded area. They are all, of course, pointing to the negative side. They're all costs to GDP, but I would say they're limited compared to the other 2 scenarios studied here. So in the middle part, you see the effects of a delayed transition, where then transition costs and physical risks are somewhat higher because you have to adapt then quicker. And then finally, on the left-hand side, you see the effects of current policies. So no transition risk here, but a very clear negative physical impact. And I think the key message from this chart is really that the cost from physical risks by far outweigh those that we would have if we had some transition policies in place. So I think this is a very strong indicator for action in the climate policy space. Next slide, please. So the NGFS scenarios also look at the GDP per country, and there are several reasons why the impact per country differs. So the transition risk component depends, among other things, on the structure of the economy, the dependence on fossil fuels, and also the trade composition. And physical risks would depend on the exposure and vulnerability to temperature increase and extreme weather events, with tropical and subtropical regions facing larger risk increases. So these are the elements that mainly drive the differences across countries. Now, the Niger model provides country and regional pathways for GDP and impacts are higher for countries and regions that face higher emission reduction, higher carbon prices, lower fossil fuel exports, or higher physical risk damages. Looking at the right-hand side, the impacts also vary across models, and this depends a lot on the model structure and assumptions. So, and here again, I would like to stress that there's a high model uncertainty, and that makes it important to look at a multitude of models and be also to be careful when interpreting results. Next slide, please. So other macro variables that the NGFS scenarios consider is, for instance, inflation and employment. In many countries, the implementation of carbon prices in the transition scenarios tends to raise energy costs in the short term. And these then feed through modest increases in inflation and unemployment before returning to prior trends. And in some countries and time periods, the offsetting positive growth effects from carbon revenue recycling can also lead to a reduction in unemployment. So some developments are a bit like supply side shocks, which then lead to a monetary policy trade-off in the sense that you may have a periods where both inflation increases, but also the impact on real macroeconomic variables is negative. And here the NGFS modeling framework actually assumes that monetary policy looks both targets a combination of inflation and nominal GDP, but this can be adjusted within the model. So I think generally one can say that more research is still needed on the potential for climate impacts to raise inflation through supply side shortages, for instance, and also to unemployment, for instance, related to displacement of workers. Next slide, please. Finally, the scenarios also look at financial markets, in particular on long-term interest rates. Those tend to increase in the transition scenarios, reflecting the inflationary pressure created by carbon prices, as well as increased investment demand that the transition spurs on. And disorderly transitions then can affect real financial asset valuations significantly, and also with considerable regional differences. So it's likely that sectors that can decarbonize less easily will be affected more than other sectors. And in line with the idea to work more on sectoral issues, the NGFS will work to further understand these impacts going forward. Next slide, please. So this has concluded my little summary, high-level summary of what has been done in the third vintage of the scenarios. So just this one slide on the way going forward. So the objective that we have is to both improve the design of the NGFS scenarios, but also as a strategic objective to promote a wider use by a broader range of stakeholders. So on the technical side, the idea is to increase the sectoral granularity and geographical coverage, which of course then can lead to a trade-off because you make those scenarios much heavier, much larger and more difficult to use. So we have to find the right trade-off here. Also, because we have faced increasing demand on that, to introduce some short-term scenarios that can in particular help policymakers to design their analysis and stress tests, for instance, but also to better find ways better to represent physical risk. And on the strategic objective side, it's really to improve usability, to make it easier for stakeholders around the world to actually use the models, also by providing some methodological guidance, for instance, and also generally to make them accessible and usable for a broader range of actors. Let me stop here. Thank you very much.
So let me now open the floor for the Q&A session. Thank you very much, Cornelia, Chris, and Ravi for your remarks and presentation. So if you have a question, please type it in the chat, and speakers will answer them.
Yeah, so I'm just reading in real time the questions that you have put in the chat. I would also ask my colleagues to step in. Maybe they're a little bit quicker than me. There are a couple of questions like Africa was missing on the GDP graphs. Yes, we had to choose a little bit to make this readable. It's available in the dataset and scenario outputs. Maybe Laura, you can also step in if you're available. I mean, some of the questions, because we will have now very detailed presentations by the modeling consortium, so some I would refer to the colleagues, like exactly why real carbon prices are lower now than they were in the phase 2. I mean, I think it relates to technological developments, but I would leave it to the colleagues.
Yes, indeed, Cornelia, I'm here. Yeah, indeed. There is indeed one question on why real carbon prices are lower on average than in phase 2, for example, in the Remind model. And Elmar is here online from the Potsdam Institute. So maybe Elmar, you can provide a quick answer to that, please.
Yeah, thank you. Indeed, it is technological development. So there are updated technological parameters, but also the granularity of the models increased a bit, and some additional technology routes were included, and that gave the models greater flexibility to reduce emission. That's one key factor for this.
I see a question on the time horizon for the short-term scenario. So I would think we still have to get into detail there, but I think like a 3 to 5 year horizon would be a good idea, because that's a horizon that policymakers typically tend to look at, including central banks. I also see what are your plans to provide forums to ask questions? Yeah, that's again, I mean, I don't think we have concrete plans, at least not from our side at the ECB. But I think it's an important point. As I said, we really want the scenarios to be used widely, and I think there should be forums to that can help users also to ask technical questions and other types of questions in order to be able to make the full use of what is provided on the website. I mean, it's a public good, and we would really we would be happy if we could make it available in a form and provide the support that they are usable.
If I may, Cornelia.
Yeah, come in.
Sorry, no, if I may, Cornelia, indeed, we also received a question about the historical damages coming from climate change on GDP. So in particular, whether we as NGFS have a view on the percentage of historical GDP that has been lost due to physical acute and chronic events in the past, because this might help to better understand what is the delta with respect to the forward-looking expected impact of climate change compared to past events. And also on this, I think that Francisca, our colleagues here from the consortium, may provide with a short explanation.
Yes, thank you. I can just say that for that, we would need to construct a counterfactual historic GDP, which does not include the damages which have occurred, and we don't have that. There is some attempts in the scientific literature to do that based on the damage function approach as well, but then of course it depends strongly on which damage function you use. So we don't have an answer per se on this.
There are a couple of questions. When is early? When is delayed in your scenarios? So I think early is if we act now according to what has been promised in the net zero and in the Paris Agreement, and anything that is delayed. I mean, you can see in some of the chart that there's a certain point in time when the trends reverse. So I don't have it on the top of my mind right now, when is that, but it would be a delay of a few years. I mean, obviously we cannot model the continuous time, so we had to make some assumptions. So one is it's implemented as planned and as promised, and the other one, the delayed, would be it's in a couple of years from now, and I would refer you then to the scenarios. And there are a couple of questions on the GDP projection. In 2100, the scenario projects a minus 18% GDP impact with respect to the baseline. So I'm not sure that I understand that why we would still be much better off then than we are now. I mean, I think you have to see this, that these GDP impacts, it's always related. It's not the absolute impact. It's always seen in relation to a baseline. And the baseline that is used here is one that assumes that simply there are no transition and physical risk. It doesn't mean that the baseline is what we think would be then GDP development that comes from other factors. So these are really taken out here. So we are only looking at the climate effects. Okay, and then there are a couple of regional questions that I would defer to the experts. Thanks very much.
Thank you very much, Cornelia, and thank you to the consortium as well. I see that there are many questions in the chat, but we will have another opportunity to take them during the second session of Q&A. So I will now turn to the NGFS Consortium of Modelers for their presentation on the methodological aspects of the scenarios. So please.
Yeah, thanks a lot, Clément. And my name is Elmar Kriegler from the Potsdam Institute of Climate Impact Research. And I will start off this presentation of the consortium by talking about the transition scenarios. So next slide, please. So anthropogenic climate change is driven by anthropogenic greenhouse gas emissions that come from our way to use energy and land. And so in order to stop warming, to transition to a world where we can limit or even reverse climate change, we need to change the way we use energy and land. And this will then help us to reduce emissions. And you can see this cycle or this causality cycle on the right-hand side of this slide where emissions are reduced and then climate change is limited, and that will also help to limit the impacts on socioeconomic systems and give us the benefit of mitigation. In order to understand how we need to change energy and land use in order to reduce emissions, we are using integrated assessment models representing the coupled climate, economy, energy, land system. And a typical output of such a model is shown on the left-hand side, where you can see emissions of CO2 and other greenhouse gases. So that's a CO2 equivalent measure from today out to 2050, split up by sectors. And you can see that they are greatly reduced and that some sectors are coming in earlier and others coming in later. For example, the energy supply sector is phasing out emissions rather quickly, even before 2050, while there are residual emissions, particularly from the agricultural sector, mostly non-CO2 emissions, methane and nitrous oxide. So let us go to the next slide, please. Just a quick word on these integrated assessment models. As I said, they represent a coupled energy, land, economy, climate system. They need to cover the globe and all sectors in order to understand what the aggregate impact of these global emissions over the 21st century will be on climate change. And their results are strongly dependent on assumptions on socioeconomic futures. So what's the future GDP development, the future population development, on technology development, on policy trends and climate protection stringency. And so this is what we vary in scenarios. We make different assumptions to come to if-then statements. If we assume such a future development, if we put in such a type of policies, we will get this kind of future. And these assumptions have been deliberately varied across the NGFS scenarios as presented by Cornelia and based on the underlying narratives here. For this work, like in phase 2, we have used 3 internationally recognized integrated assessment models, the Riemann-Magpie model, the GCAM model, and the Message Globe Biome model. And those have been publishing in the scientific literature since a long time and also contributed a large number of scenarios to the latest assessment of the IPCC. Next slide, please. Here we show again the resulting carbon price developments across the 6 scenarios and across the models. So in the upper panel, you see a figure that was already shown by Cornelia, basically showing how the carbon prices are increasing as expected with target stringency. But then you have some additional effects here in the delayed scenario where the heavy action, the heavy lifting only kicks in after 2030. You can see this increase in carbon prices after 2030. And also in the sectorally disaggregated scenario, the divergent net zero, you can see on average very high carbon prices because in some sectors there are quite high carbon prices. It's important to recognize that these carbon prices are a proxy for policy intensity. So they are shadow prices of imposing the target and acting on the target. In reality, governments are pursuing a range of fiscal and regulatory policies, including carbon pricing policies, to achieve these outcomes. And those results depend on the model, on a number of assumptions in the model. You can see this in the lower graph, where there you see the carbon prices for one scenario, the net zero 2050 scenario across the 3 models, and the mean carbon price is in orange. So what you see here is that on average, you would need a carbon price of $200 per ton CO2 in this decade in order to be on track to net zero 2050. Next slide, please. So another important information we get from the integrated assessment models is about the transition of the energy sector. So this includes changes in the primary energy mix due to the transition. You see this in the right hand graph where we show the energy mix changing over time for two scenarios. One is the current policies scenario, which is basically extrapolating current trend. And you can see that there's a slight increase of renewables in that scenario, but structurally the energy mix is basically staying quite stable here, while that is very different in the net zero 2050 scenario where renewables are taking over the energy system, and in 2050 there's only some residual oil use still in this scenario, but other than that it's all renewables. And this is reflected on the investment side, where you can see that investments into fossil electricity reduce completely in the net zero scenario, and the investments into low carbon technologies and storage are increased significantly. And some of the residual emissions and investments into fossil fuels are legacy investments of existing fossil fuel infrastructure, so not new investments. So let's go to the next slide, please. Another aspect of these transition scenarios is the use of carbon dioxide removal from the atmosphere. There are various technologies how this can be done. One example is to simply plant trees to a forest and so increase the carbon stored in the terrestrial biosphere and reverse the historic deforestation trends. Another technology that is used for carbon dioxide removal is bioenergy combined with carbon capture and sequestration. So you would combust the biomass, and then the oxidized carbon, the carbon dioxide, is not put back into the atmosphere, but rather sequestered in geological formations, which has a net effect of removing effectively carbon dioxide from the atmosphere. All 1.5 to 2 degree scenarios here in the NGFS set are using carbon dioxide removal to some extent as a complement, not a substitute to mitigation. And you can see that the models differ a bit on what type of technology they use, but they all use it to some extent. So let's move to the next slide, please. Here we provide a comparison of the NGFS scenarios with the assessment of the IPCC, the Intergovernmental Panel on Climate Change, which published its report, a report by Working Group 3 on mitigation in April this year. And also we compare the NGFS scenarios with the IEA Net Zero 2050 scenario that was published in 2050. So what you can see here is that they are fairly consistent with these two other points of comparison. They have a somewhat lower energy demand compared to the assessment in the AR6. And the IEA is also on the low side here when it comes to energy demand. When we compare carbon dioxide removal outcomes, IEA is the lowest, and then the NGFS scenarios sit at the lower end of the IPCC range, and the NGFS scenarios sit at the upper end actually in terms of share of wind and solar electricity compared to the sixth assessment report. So the basic finding here is that they are consistent with some variations. And this concludes my part of the presentation, and I'm handing over to Philip, I think, on the EASA Explorer.
Yes, thank you. Thank you, Elmar. So hello, everyone. My name is Philip Hagstock. I work for EASA, and I will now present a very quick overview of the EASA Scenario Explorer, which is one of the main points where you can get the data. Starting at the landing page, this is the first thing. I have put the link for you in the caption here. The first thing that you'll see on the left side is the contact and the release notes part. Contact is quite important. If you have any questions, if you find any issues in the data, please don't hesitate to reach out to us. Additionally, you will find the release notes. This is ongoing, and as soon as we have new data sets, new versions of the data set where usually small issues here and there are fixed. You will find them there. On the right side, you will find the register and the login option. So you can register either as login either as a registered user or as a guest. The difference is that if you are a registered user, you can save your workspaces. Which brings me to the next point. Next slide, please. We have some workspaces. So this is sort of the first thing that you will see when you log into the Scenario Explorer is these workspaces. We have prepared 6 of them for you to get a really quick overview of some of the indicators in the models, but you can also create your own. You see on the top left corner and the marked in the right, there's the Create New Workspace option. So if we take a look at the next slide, please, then you can see how you would create your own workspaces. You first select a combination of model and scenario, then you select a number of variables and then a number of regions. If we go to the next slide, you can see what kind of options you then have. We have different options for the plots. There are line and bar plots available. You can have them as a single chart or stacked to sort of have see cumulative effects. If you are a registered user, as mentioned before, you can then save these workspaces and you can also share them with other people. I realize that this is very quick. This doesn't cover all the details, so more information can be found on the link displayed on the slide, which also includes a number of tutorial videos. Moving on to the next slide, there is also a documentation section as part of the Scenario Explorer where we provide more information on the different axes on the model, the scenario, the region, and the variable axis. If we go to the next part, perhaps most importantly, you can get a quick overview in the workspaces. But as we see on the next slide, please, the download section is where you can get the full data set and undertake comprehensive analyses. Also, you'll find the release notes there. If you use the data set, we would greatly appreciate it if you cite it. So you'll find the DOI identifiers there. Finally, the last part, I want to go over some structural changes from phase 2. So we did a little bit of model restructuring in terms of the nomenclature that we're using to make it a little bit more clear. So this affects both the downscaling and the NIGEM model. For both of them, we moved the fact that this is the model into the model name. So before, for downscaling results, we had the country and then in parentheses the name downscaled. We have now eliminated that, and instead the model is now called downscaling, and in parentheses what kind of a model input. In analogy to that, we have done the same or a similar thing for NIGEM, where for the current policies, as this example here, we had the input model as well in the scenario name. We have moved that into the model name. So now all the scenarios are called the same. It's the same exact thing, no matter if it's post-processed or model native. Finally, the baseline scenario, which in phase 2 was called base scenario and then was specific for each model, we have just renamed to just baseline, and the model information is in the NIGEM model name. Finally, as some of you might have already noticed, there are the downscaled country level non-CO2 land use emissions. These are not reported as it was found that there are some issues with the downscaling algorithm, and it currently doesn't support those. So with that, this is all from my side, and I will now hand over to Anne, I believe.
Thank you very much, Philip. Yes, so I'm leading over to the perspective of the impacts of climate change, speaking about the physical risk work under the NGFS phase 3. Thank you. To recap, there's 2 main types that can be differentiated for physical risks, which might also answer some of the questions. So there's chronic risks, which are slow onset changes, such as temperature increase, precipitation pattern changes, sea level rise, which of course can specifically affect the weather-dependent sectors economically. And then there's acute risks, which are extreme events, extreme weather events, such as tropical cyclones, wildfires, floods, heat extremes, and droughts. And these can lead to business disruption, destroy infrastructure and assets, and also impact labor productivity. And the graph on the right probably already looks familiar to you. And so what has been done in the project is that from the transition scenarios that we've just seen before. The emissions that come out of these are translated, so the carbon emissions are translated into temperature changes, mean temperature changes, and this is then taken into account when estimating the chronic and physical risks for the different NGFS scenarios for the climate change impacts. And then, which will be shown and explained in more detail a bit later, is both the chronic and the acute physical risks are then fed into a macroeconomic model NIGEM. And as you've already seen in the YASA Scenario Explorer, selected results from the chronic and the acute risks are available for download, as Philip just presented. And there's also a second tool, which is focusing more on the impact side only, which is called the Climate Impact Explorer, which my colleague Jakob will now show to you in more detail.
Yeah, hello all. My name is Jakob Ans. I'm working at Climate Analytics, and I have the pleasure to present to you the Climate Impact Explorer. This is an online tool that's available on the URL seen below here. Next slide, please. And when you enter the web page, what you come up with is a selection here in the red box, where it allows you to choose countries or regions, even down to provinces. You can choose from 31 different indicators, for example, mean air temperature, precipitation, damages from tropical cyclone, or damages from river floods. And you can select from 8 scenarios. That's including 3 NGFS scenarios, 1 from the Climate Action Tracker, and 4 from the Representative Concentration Pathway, short RCP. When you have done your selection, what you see then is the figure below here. The blue line in the middle, that's the mean indicator in spanning from 2015 to the end of the century, 2100. And the bluish background line that you see, that's the confidence interval relating to the uncertainty. This graph can be downloaded in different formats as well, as seen here in the red bubble. Next slide, please. There's a second figure available. That's a spatial map. A user can choose here between different temperatures scenarios, 1.5, 2, 2.5, or 3 degrees. It's also possible, as seen here on the right side, to compare these maps, for example, for different scenarios or different warming levels. Again, it's possible to download this under different formats. At the very bottom, we've included the user survey here. Next slide, please. So the data that we're showing is coming from 2 projects. The first one is the EasyMap database being maintained at the Potsdam Institute for Climate Impact Research. And the second one is coming from CLIMADA, which is a probabilistic natural catastrophe model that's maintained by the ETH Zurich. Next slide, please. So what could that be used for? The data, if you've seen there, could be used to supplement national or regional risk assessments. It's however important to mention that the data is derived from global models. So downscaling that to the local areas, it's important to validate the data via local sources and to do validation of the indicators. We have also included the user guide now to guide the user a bit how to use this data with an example and how to interpret it. Again, the CIE, the Climate Impact Explorer, is part of the NGFS work, and we are currently working on the extending of the functionalities, and we'll expand that in the future and validate further data in the future. Next slide, please. So for this NGFS update, we've included the new NGFS scenarios. We've improved the visualization of the data and the uncertainty ranges around the projections. We've included more explanations about the data and caveats. We've included bulk data download description, how data could be downloaded using an API script. Again, I've said that already. We have included the user page that guides the user a bit how to use that data. And I think I conclude with that we've added a survey, and we're very happy if users would take that survey so we can understand what requests you would have from such a tool in the future, and how you're using such a tool and how you would like to use it in the future. Thanks very much. Next slide, please. With this, I hand over to my colleagues presenting chronic physical risks.
Yes, thank you very much. I'm Franziska Piontek, and I work at the Potsdam Institute. And I will tell you about how we quantify the chronic physical risks. Next slide, please. As was already said, we use the quantification by Kalkulenbenz. This is an empirical estimate using historical GDP and temperature data to empirically estimate how temperature affects GDP growth. So the delta, which can be seen here, is essentially the correction factor driven by temperature increase, and that affects the standard GDP growth, denoted with G here. And as you can see in this formulation, this effect is driven by the annual temperature change, largely. We used the same formulation already in the previous phase of the NGFS. And what we have included now is also the high damage estimate. So as you can see in the figure below, previously we used the black line, the central estimate, and now we add the 95th confidence interval towards higher damages. The reason for that is we would like to reflect the uncertainty on the damage side. And also we know that these damages do not include, or these estimates do not include all of the damages. And so we, at least since we can't include all the different aspects, we at least would like to support the stress test idea of this exercise by adding this 95th confidence interval as well. Next slide, please. Here is a result to just show you the difference this makes. We see here the percent GDP loss over the century for the median GDP change in blue, and for this high GDP change, for this high damage estimate in red. The uncertainty range here shown for these two then comes from the climate uncertainty. And you can see this here for the current policies and also one of the policy scenarios. And you can see that using this high damage estimate approximately increases the damages by about 2/3. Next slide, please. So the previous result was from the post-processing of the damages. So we just take the output from the IAMs and calculate the damages using their GDP trajectories and their temperature trajectories. If you do that, you miss the dynamics the models would have in responding to these damages. And so what we also provide as part of the NGFS data is results using the Remind integrated assessment models, where these damages are integrated. So in the scenarios, both the transition risk and the chronic physical risks are included in the modeling and affect the outcome of the transformation pathway. And it affects that on the one hand by a different investment pathway. If you have the damage already in there, then the investment decisions will be made differently in the model. And also because these damages, foreseeing these damages will affect how the mitigation strategy occurs, and it mainly results in a higher near-term mitigation effort. And with that, I pass on to Anne, I believe, for the acute physical risks.
Thank you. So leading over to the acute physical risk side, so the extreme events and why the financial sector should care if you don't already do. Next slide, please. So already today, the financial damages from extreme events are substantial. The World Meteorological Organization reports that the global economic losses amount to over $3.6 trillion since the 1970s, and that the number of disasters have already increased by a factor of 5. And with climate change, these extreme weather events are projected to not only get more frequent, but also more intense in many regions. And as we already saw for the Climate Impact Explorer, that allows you to explore the projected impacts for your country or region of interest for a larger number of estimates. However, of course, it's important to generally better understand and assess the acute risks and the related economic impacts for climate change. And this is why for this, as mentioned before, this phase, we for the first time linked selected extreme event indicators to the macroeconomic model NIGEM, to provide a first estimate of these global macroeconomic impacts related to the acute risks in the NGFS contexts. And we're also planning to do more work on this. So next slide, please. So what have we done this phase? We've used reported historical damages from weather-related disasters that have happened already in the past from the EMNAT database, and we've combined that with GDP data to represent the historical damages from acute risks. And then to approximate the future changes in frequency and intensity of these extreme events, we've used projections on direct losses for river floods and tropical cyclones from the Climata model. for the 3 NGFS scenarios, which you can see in the Climate Impact Explorer. And this has been fed into the NIGEM model. And it's important to note that this is a first step of work. It's not yet comprehensively covering all types of acute risks. And there's further work planned on this. And then, as mentioned, both the historic and the future scenarios have been input into the NIGEM model to assess the macroeconomic impact on a global level. And this will be explained in more detail by our colleagues from NISA in a moment.
Thank you very much, Anne. My name is Jan Elias, and I will be running through the role of the NIGEM in this project. So the quick overview of what I'm going to talk in the next 5 minutes or so. So I will quickly touch upon how the climate change scenarios are modeled within the NIGEM. So it's a high-level view of the scenarios, and we will look at what are the changes between the phase 2 and phase 3. And we will just quickly look at the charts, to show the illustrative example of what comes out of the NIGEM as a result of the project. Next slide, please. So when we look at the NGFS phase 3 scenarios in a NIGEM, so good news is that the approach to the modeling of the climate change-related scenarios in the NIGEM in phase 3 hasn't been substantially changed relative to the phase 2. So the approach is basically the same. And what we mean by that the scenarios, climate scenarios, are broadly categorized, like in the previous case, into the physical and the transition events. While the events of physical and the transition shocks alongside the policy decisions are contemporaneous, the scenarios in NIGEM can be run in a stacked manner. And what we mean by that is that each scenario uses information provided by the previous scenario, and that uses it as a starting point, so builds up on the shocks, and which this allows user to disintegrate and decompose the shocks and its effects. So you can see separately physical shock, impact from the physical shock, separately from the transition shock, and together from the combined one. So the slide in front of your eyes shows those two channels, and the top one, the gray area, shows the impact from the peak institute. So this is the data on the GDP damages that we get from the calculus advance, and this is fed as an exogenous input into the NIGEM. So why we mention Climata in the brackets underneath is, so this is just to illustrate that the work is undergoing on the role of the acute physical risks as well, and it will form part of the input in future into physical shocks as well. At the moment, it's only the chronic physical shocks that are modeled or used. So the middle part shows the role of the inputs, what change they undergo within the NIGEM itself. So the GDP damages, the information about GDP damages are used as both supply and demand shock in the NIGEM, and the effect of those changes is given by the main channels on the right-hand side, which is the lower productivity capacity and the lower demand. So if we look at the transition shock, so what are the inputs that are used by from the IMs? It's again given by the gray rhombus, and these are the carbon price, primary energy, useful energy, and carbon revenue. So what happens that to those inputs into the when they are entered into the NIGEM is given again by the blue squares. So we are seeing the impact on the energy use in the NIGEM, which is the lower energy use. It leads to the lower productive capacity in the economy. Also, the lower energy use leads to the lower demand for the energy prices. So we will see as a result lower pre-tax energy prices. In terms of the role of the carbon tax and revenue from it. So first of all, the carbon tax will increase the effective energy tax rate in the model, which acts in a similar manner of the VAT shock, and it will increase the domestic inflation, so prices will increase as a result of the increase of the carbon taxes. And in terms of the revenue, so this is a very important channel for the in terms of the recycling of the carbon taxes. So it will affect results quite significantly. So the sensitivity of the results will be obvious depending what do you do with the carbon tax revenue, so the way you recycle it. Another blue box, which is important as well to keep in mind when analyzing or thinking about the output from the NIGEM, is the monetary policy, because it plays quite an important role. It's a very important feedback mechanism, so the monetary policy role will play a significant part in the results as well. And the last box in the middle part is the investment uncertainty. So this is the additional shock that has been added, similar to the phase 2, to the disorderly scenarios only, to basically capture the higher investment uncertainty, business investment uncertainty in the disorderly scenarios. Next slide, please. Now we will look a bit more in detail how the shocks are propagating in the NIGEM, and then we'll look at the changes relative to the scenario. So second phase. Chronic physical effects first. So as I was already mentioned, the chronic GDP damages from the calculated events are fed into the NIGEM as the demand and supply shock, and at the same time it represents the GDP target, which we are trying to match by when we apply the shocks within the NIGEM. So the shocks are applied to demand and the supply, NIGEM is run, and then the output from the NIGEM GDP is compared versus the GDP target from the calculated events damage functions. If the two are equal within the convergence criteria, then we stop, and that's the output that we are getting. If not, we have to modify both shocks, demand and the supply, further to basically, and this process is continued but once before the matching is achieved. Next slide, please. So in terms of the differences from the phase 2, for the chronic physical effects in NIGEM specifically. So as you already heard from Francisca, we are using the high GDP damage values for the chronic physical risk, so rather than the median like it was in the second phase. Very importantly, trade in the NIGEM for the chronic physical effects are switched off. So global linkages are exogenized, and this is done to match closely the damage function output from the calculated events. Another change is that the monetary policy, when we run the physical shocks again, is switched off as well. This serves dual purpose. The first is again to match the calculated damage function results, and the second one is to remove the differing policy environment between the carbon price shocks and the physical shocks. So we are considering that the same environment should be applied in terms of the monetary policy, and if we run the physical shock under the different monetary policy, so there will be the mismatch. So we are exogenizing the monetary policy fully. Next slide, please. Thank you. And the chart illustrates the point which has been already mentioned throughout the presentation. So the impact on the world GDP only from the physical effects. And as you can see, in line with the previous presentation, the largest damage, or so the fall in the world GDP is largest with the current policy and the national defined contribution, so the hothouse impact. Next slide, please. I will just touch upon the acute physical effects in NIGEM because Anne already extensively covered them. So how we model them. We use the information from from the outside source based on the historical extreme weather effects. And that gives an information about the GDP damages and their frequency of occurrence. And another source of input, again exogenous, which we get from the Climata database, is the projections depending on which scenario we are going to run. And this will look at the change in the size, on the magnitude of the GDP, and the frequency as well in the future. So these two outside inputs are fed into the NIGEM, and then the stochastic trial is run. So it's a Monte Carlo simulation, a stochastic trial, and it will give us the confident bounds based on the shocks that has been applied. The chart below illustrates just that. And this is given for the world GDP only, and the chart shows for the current policy. So this is the deviation from the base, and it gives us the range of all the percentiles, including the 99th percentile. So the output from the acute physical risk can be wrapped around as an additional shock on already realized or run transition and the chronic physical effects. Next slide, please. So what are the changes in terms of the transition effects when we model them in NIGEM? You will be pleased to hear not much, but what you will notice is that in the current NGFS portal, when you see the NGFS transition output numbers, so what it means, unlike the previous case, it now comprises of two shocks: carbon price and the revenue recycling, i.e. in the previous stage, what we had transition was only the output from applying carbon price shock. Now we run first the carbon price shock, then we apply the recycling options, and the resulting output is now called the transition shock. Next slide, please. The differences from the in terms of the transition effects from the previous phase relative to the current. So the first one is that carbon price shock, so which I already mentioned. Carbon tax revenue is now provided directly from the IM models rather than being determined from the fossil fuel consumption and carbon tax within the NIGEM. So that gives us the better mapping with the IM models. Producer prices effects have been extended. Now the fossil fuel exporters expanded in terms that it includes Russia and Egypt. And the last one is that it's a recycling. So all carbon tax recycling is introduced now as a second round effect shock, rather than integrated as the one and encompassing all together with the carbon price shock. Next slide, please. So the chart, the illustrative chart, shows those the impacts from the transition and the chronic physical effects. So the black line is the transition. This is the relative to the baseline, and the gray line is the chronic. And two together, if you add them up, you have to get the final result. And that should be now, as I said, available in the NGFS portal. The next slide, please. And if we look at you already seen this chart as well across the models, you will see that the impact, this is again the world GDP impact relative to the base for net zero. The impact on the GDP across the models will vary. Specifically, for example, for net zero, the output from the GCAM and the remind will be very similar. However, with the message, you will see the GDP damage to be much larger, so the fall is larger, and this is largely due to the higher carbon tax applied as a shock in the model. And that's it. Thank you very much.
Thank you very much to all of you for this very clear presentation. So now I will open the final Q&A session. So I see that there are already some questions in the chat. So I'll start with this one. Are the parameters of the phase 3 scenarios the same than in phase 2? And what are the main changes?
Yeah, I'm happy to take this one, Christopher Bertram from PIC. So the narratives of the scenarios haven't changed. So mostly the kind of top level parameters are the same, but there are differences in kind of the details. So for example, the net zero targets of countries have been updated to reflect latest pledges, as also with kind of NDC targets and current policies. And then the higher granularity of the models also obviously means that there's differences in kind of the parameterization of different technologies. And lastly, GDP assumptions from IMF for the short term have been updated.
Thank you, Christoph. Another question, how is the baseline scenario constructed? Sorry.
If it relates, sorry, to the baseline in terms of the NIGEM, so the approach is very similar to what we have done previously. So what we take the population projections and the GDP growth projections from the integrated assessment models as well and the energy consumption, and we overlay that with in the latest vintage, the version as a January version of the model really. So in that case, just I have to underline that the COVID assumptions data, which was come through up to that point, is on the base. However, there is no assumption related to the Ukraine war has been added.
Thank you very much, Jana.
Maybe I can add on the integrated assessment models, because depending on the type of model, you have different types of baselines. And for the integrated assessment modeling, what we do is compare a counterfactual without any climate policy, extrapolating emission trends, or just putting in the current policies and then extrapolating the trends with these transition scenarios. And you can also see this in the IPCC assessment published by Working Group 3. There are different types of these reference scenarios, and the standard practice of the community is now to take the current policy scenario as a reference point, because we do have a lot of policies now on the ground, and it's no longer useful to take the counterfactual no policy baseline.
Thank you both. A third question, maybe, can we find investment needs in various energy sources in the database?
Yes, thanks for the question. Yes, you can find them. They are, so as you will see in the scenario explorer, there is this kind of variable hierarchy, and the naming convention, the hierarchies are split by the pipe characters, or the vertical bar, basically. And so you will find it under the post-processed hierarchy. You will find it under post-processed pipe investments, and then you will find all the different energy sources.
Thank you, Philippe. So several questions on CDR, carbon dioxide removal technologies. So how plausible it is it given that carbon sequestration market is untested, and do the assumptions take into account availability and scalability of the technology?
Yeah, thanks for the question. So scalability is included in the modeling, and also the growth dynamics of trees, for example, when it comes to afforestation. These considerations are included. And yes, it's still the amount of CDR seen in the scenarios has been limited to some extent, but it's still substantial, as in most of the literature on 1.5 and 2 degree scenarios, pointing out that we are also moving into uncharted territory, not only with CDR here, but also if you look at the amount of hydrogen markets, for example, or the high degrees of electrification reached in 2050, which is all part of this transition of the energy system and the land use system. And I've seen coming up a few additional questions on the baseline. Just wanted to clarify. So the current policy scenario was always the reference scenario in the NGFS set from phase 1. So that didn't change. Only if you look back into very old community publications, like 10 years ago, usually the no policy counterfactual scenario was used as a baseline, but this really has changed now in the community. Thanks.
Yes, just to mention that the baseline scenario, which is available in the data set, is the base scenarios from NIGEM, which does not include transition nor physical risk, which is an hypothetical scenario. Another question on the priorities of the NGFS scenario. So do you take into account the impact of other planetary boundaries, such as the biodiversity loss? I think that's for the ECB.
Happy to take that question. So in the NGFS, there is actually a work stream that is looking at biodiversity loss and other environmental factors. So the current scenarios don't yet take this into account, but we are planning to do so at some stage in the next vintage. But it's probably not the very first priority, because we would first like to get started on the other ones that I had mentioned earlier on. But we will look at how we can take them into account. Thank you.
Thank you, Cornelia. What are your recommendations regarding which data from the IAMs to use? Which ones are used by central banks? So I don't know who wants to answer this.
Maybe I can just say that I don't know which type of scenarios are actually used, but we do know that more and more central banks, namely NGFS members, mostly probably, but not only, are using the NGFS scenarios now. For instance, for stress testing, we did a little survey last year, where out of 31 respondents, 22 said they were already using this in some form, and also some other central banks have adapted their own proprietary models to suit, have adapted, the scenarios to suit their specific needs. So we hope that this will increase also in the future. Thank you.
Thank you, Cornelia. One question on the scenarios. Is there any scenario that will assume some sort of decreased consumption, maybe for the IAM teams?
In the current NGFS set, this is not the case. We are basing these projections of GDP and population on a middle-of-the-road narrative called SSP2. But the literature knows a number of scenarios that either have limited growth, but more prominently limit energy and land demand, because you can still have a growing economy and reduce energy demand strongly. And I think that's also a topic for phase 4, to look into a broader set of socioeconomic assumptions, including this type of scenarios.
Thank you, Elmar. Thank you all. So I'm conscious of time, so we'll now have to wrap up this call. We hope that you enjoyed it and that you found it useful. Just before we go, we would ask you to fill in a quick feedback survey that is available on the screen, and I also put the link in the chat. It takes approximately 1 minute and is extremely useful to us, so it would be nice if you could fill it in. Otherwise, I wish you all a very nice morning, afternoon, evening, depending on where you are. And thank you, and have a good rest of the day.